A&M University, and his MS and PhD degrees in agricultural and applied
government budgets. It's not a rosy picture for how we're going to move forward in terms of potential government programs and stuff like that. Now, I want to switch the gear. I'm going to run through these pretty quick because they mean nothing to you, except that this is the value of the Turkish lira relative to the dollar. And this is just a 6-month change in the value of the Turkish lira to the dollar. That's a massive depreciation. Now, you can see right here, we're going from 4 to 6.5, 7. Back in the day, back in the 90s, I was in Turkey for about 2 months. And it was the old Turkish lira. And when I showed up in Turkey, it was 75,000 lira to the dollar. And when I left, it was 180,000 lira to the dollar. I used to joke that they invented the little digital signs on the gas station so that they didn't have to go out and change the price of gas 4 or 5 times a day. You know, that was how bad their inflation was. Well, this is occurring, but this isn't occurring necessarily because Turkey is in bad shape. It's occurring because they have an autocratic dictator take over the government who is bucking NATO, bucking the European Union, the United States, everybody else. Now, why do we care? Because Turkey is one of the largest consumers of U.S. cotton there is. And with every tick moving this direction, U.S. cotton gets more expensive in Turkey than the day before. So that means they're going to buy you less U.S. cotton. This is at the same time, again, that we're facing potential declines in exports to places like China because of the tariffs. Right, so this is happening at the same time. Now here's the Argentine peso. Same story. Different problem altogether. The Argentinians are perpetually bad at managing their own government. And so they're a socialist country. They spend way too much. Why do we care about this? Because Argentina is a competitor for U.S. markets, particularly soybeans, but also corn and to some extent cotton. Not as much, but certainly corn and soybeans, Argentina. So with every tick this direction, the Argentinian bushel of Argentinian soybeans gets cheaper in world markets. So they're our competitor. The Indian rupee, same thing. Second largest producer of cotton in the world. Cotton getting a lot cheaper. Got a 25% tariff in China, competing against an Indian crop that is closer, has less transportation costs, and is now getting cheaper by the day. Brazilian real, same thing. Brazil is a big cotton exporter, soybean exporter, things like that. So these are major competitors. Turkey was a major consumer. These are major competitors. On both sides, both of these currency slides are not good for U.S. agriculture, U.S. agricultural export. And so there's a bigger problem, though, that these aren't the only ones. Okay, when we look at most emerging markets at this point have seen roughly about a 40 to 80% drop in currency value. That is not a good sign. That is the sign of a contagion that is spreading around the world, starting out in emerging markets, that is could potentially then spill into developed markets like the European Union and the United States. These are inflationary markets. We all seen what's happening. I mean, you know, it takes a pile of cash this high to buy a roll of toilet paper in Venezuela. They've had 1,000 to 2,000% inflation now for months. Those kinds of things, if they spread around the world, have really adverse impacts on U.S. markets and potentially could spill into a recessionary type situation in the United States. So, overview then, growing U.S. debt is a problem, currency collapse is a problem. Are we getting ourselves in a situation where commodity-wise, those markets are likely to fall out from underneath us? They haven't yet. Okay, if you look at those markets, they haven't yet. We've lost a lot, but some of that was baked into the pie early on for other reasons. Now, talk about a couple of commodity markets real quick. I call this the good. If you're a cotton farmer, you're laughing. No, it's not. But it is. Relative to other places, this is pretty good. So we're still in that 80 to 83 cent range in cotton or have been trading. That's still historically high for cotton price. Now, one of the issues that we're going to see going forward is we see this, but we're going to see basis changing. Because as the basis, as shipments to China and things like that slow down, we start seeing longer storage times, stuff like that. The basis starts to change on us so that the cash price slips, even though the futures price has remained relatively high. But that is, the fact that we've gotten to this level and we've stuck at it for now, given a 25% tariff and given these other conditions that are going on around the world, is a pretty good sign that there's still some significant demand out there for cotton going forward into the next year. But if you're sitting there looking, if you're a producer, you're saying looking at December 19 cotton at 83 cents, I'd at least think about some options, on trying to protect that 83 cents going forward, because it can fall out from underneath in a heartbeat. At least with an option, all you're out is the premium up front. Well, corn isn't pretty. Okay, we've lost a lot of value here in corn. Low, mid $4 range, now getting back down into the mid $3 range. Same sort of situation. We're facing headwinds in export markets. We've got large crops in the Midwest. Okay, so record soybean and corn yields projected at this point in the Midwest. All of those are sort of a perfect storm for lower prices. If we look out into the future, and this is actually 19 corn. So that's giving you an indication of what the market thinks about a year from now. We don't want any more corn. We don't need as much corn as we have. And then it's really ugly in soybeans. Soybeans has been nasty. So soybean markets have been hit. They've been hit by a number of things. Soybean growers will tell you this is all the Chinese tariff. But this was occurring before the Chinese tariff was ever announced. Okay? The slide had already begun. It was really a supply-demand situation, more so than it was an individual policy. And then the Chinese tariff just sort of added fuel to the fire. So, now one thing about trade, this is just to make sure that everybody thinks about the broader picture. When we see something like what's happening in China, China slaps a tariff on soybeans. We ship less soybeans to China. Does that mean that we're throwing soybeans out on the ground? No, it means that those soybeans are going to go somewhere else. The Chinese are going to go to Brazil and they're going to buy soybeans from the Brazilians. And so wherever the Brazilians were selling soybeans, the U.S. then has to fill that market. Okay? It's a fluid market. It's like water. You pull it out of one place, it goes someplace else. Now, will it be lower value? Absolutely. It has to be lower value, or we'd have been shipping it to that place in the first place, right? We've been shipping. Brazil was shipping to Australia, and now we have to. We got to sell it for cheaper than we would have to make that work. So the value is going to come down, and that's where this, you see this bouncing around as the market's trying to figure out where that new value may be. But it's not all tariff. Okay, this is not all tariff, and it's not the end of the world. So will tariffs matter to cotton? Since that's it. Here's historically where we send our cotton. From 78 to 2005, this is the average. Most of our cotton went to Japan, Korea, Australia. Australia is a little player in that, but Japan and Korea were the biggest consumers. And our second biggest customer has always been NAFTA countries, so Canada and Mexico. Now, if we break that out, we look at 2016 or 2006 to 2017, which that's the last year we have complete data on. The ones in red got smaller, the ones in green got bigger, but obviously the big player here is China. They bought up all our cotton. They bought up all our sorghum before too, right? So they come along and when China decides it's going to buy something, they go big. They buy a bunch of stuff. So they bought our up to about 30% of what U.S. exported went to China over the 06 to 17 period. But the interesting thing is if you break that out into the last couple of years, China's actually pretty small. China's down to about 15% of what the U.S. exports. Most of what we export now goes to Southeast Asia. Vietnam is the biggest consumer, but Bangladesh, Cambodia, Thailand, Indonesia, places like that, all over Southeast Asia. Why? Because all of the textile, or a lot, not all, a lot of the textile manufacturing here is moving here. Because, believe it or not, labor rates are going up quite rapidly in China. And so those same textile manufacturers, not just labor rates, but the stupid textile or the stupid cotton policy that China has makes cotton expensive in China. Right now, the landed price for at a mill in China is around $1.20 a pound. That's how much the cotton costs, about $1.20 a pound. So U.S. cotton, as long as we can ship it for less than $1.20 a pound to China, is still going to go to China. We're still going to sell, we're still going to hit 5-6 million bales. Even with the tariff, we're going to hit 5 or 6 million bales of exports to China. So the question is, in the short run, no. Okay, in the short run, those tariffs on cotton are not as big a deal as the media likes to make it out. It's a much bigger deal on soybeans than it is on cotton. And mainly because of what I just said. Because the internal prices for cotton are so expensive in China to begin with. So we don't know what the price would be. We're at 83 cents. So we don't know what the price would be, and I put the but for, that's a legal thing, right? But for. We don't have the counterfactual to say this is what the world would look like in the absence of Chinese tariffs, because we don't live there. We live in a world where we have 25% Chinese tariffs. So the prices we observe are the prices we observe. We can't go back. But we do have historically high levels of robust demand. Vietnam has now surpassed China. Other situations are holding those prices up higher than they have historically. So we're not bad off. We could have been better off without the tariffs, there's no doubt. I think it's safe to say that if you are in agriculture in the United States, you are much better off with good, well-enforced trade agreements than you are with tariff payments or whatever it is that are going on. Now, in the long run, absolutely tariffs are horrible things. Those markets are going to adjust to new realities. We'll have different supply chains that have to develop if these tariffs persist. So if you think about sorghum, I remember when sorghum, China came in and bought all that sorghum price went way up. Barry remembers this, right? Yeah, that was great. But the problem is that China's an intermittent buyer. And so you have a really well-established supply chain with Mexico, where you're sending a lot of the sorghum consistently, and they're making product out of it. And now you're going to disrupt that supply chain. And you're going to send that stuff over here to China because you've got an extra 20 cents a bushel. And now the Argentinians and other people start creeping into your market saying, hey, we'll deliver to you on a regular basis. We're not going to chase that. So, yes, tariffs matter because they create new supply chains. And those supply chains aren't necessarily to our advantage. Prices are going to have to come down to adjust to those market realities if we stay with, have those tariffs. Over-reliance on tariffs, and this is a statement I'm acting the government on Twitter. Over-reliance on tariffs as opposed to good trade agreements are not in the long-term interest of agriculture. We don't want tariffs to disrupt the flow of our goods around the world. What we want is well-executed trade agreements. Now, that doesn't mean that any trade agreement, right? It has to be a good trade agreement. But those are better in the long run than tariffs, because tariffs really mess markets up. They create all kinds of problems. Now, I'm just going to leave that one there for you. People always ask, what does that mean? If you're a corn grower, you know exactly what that means. It means you're getting 1 cent a bushel in a tariff reimbursement payment, and soybean growers are getting, what, 48 cents a bushel, something like that. Was it? Yeah, it's $1, whatever it is. It's a huge amount of money. Most of that $4.5 billion is going to soybean growers. So if we could turn this into soybeans, we'd all be happy. But unfortunately, it's just like this. Okay, I'll stop there. Any questions?